I welcome everyone to Prabhudas Leeladhar Asset Management's quarterly review call. My colleague Siddharth will be taking this call today. He's just logging in for us in a while. During the call, if you guys have any questions, if you have any requests, or you want to know more about the strategies, please feel free to write in a chat bot or probably in Q&A session, and we'll answer your questions during the call. The process of the call that we would like to take is that we would first take you all through how our quantitative parameters and strategies have done, how India market looks like to us in coming few quarters, and what our quant models are suggesting for all the investors from the investing perspective. At the same time, any specific questions you may raise your hands, and probably we will be happy to take your questions. We are open. We would prefer more to be more an interactive sessions, and we really thank you everyone for taking out your time and attending our call. Yeah, India had been vulnerable, and so does the global market from our last call till now due to the tariffs, uncertainties, and a lot of other issues. With this, I would just request Siddharth to take this call forward. Thank you, everyone, for your participation.
So welcome everyone, and I guess good morning to many people who are attending, from the West. It's 8 p.m. here, and I'm assuming it's roughly 8 a.m. Wherever you guys are in the US. I think last couple of quarters have been very, very interesting, challenging, turbulent altogether. I think the markets have seen extreme amounts of choppiness, volatility, drawdowns, and the main thing that changed in the last 6 months for Indian markets was that the markets became buy bad news, ignore bad news, buy the dip, to sell good news and sell on rise. So I think a lot of things changed in India over the last 6 months. And I think as we stand today, again, we are in the third major change. So I think post-COVID, we've seen roughly 3-4 different cycles play out in India. One was obviously the COVID crash, which was sharp, fast, extreme, and the subsequent recovery, which lasted a good 2 years. We made new highs, and there was a solid recovery in Indian markets. Post that, there was a phase of correction and consolidation from September 22 to mid 23 or March 23. Again, March 23 to June 24 was a phenomenal run for Indian markets. June 24 to December again was a phase of consolidation, a sideways sort of market. Valuations were excessive, growth was moderating, FIIs were selling, and things were a little choppy, but we didn't see a capitulation or a bear market crash in that phase. January is when things start getting ugly for India. I think a lot of global and local factors start playing on at the same time. From excessive valuations, moderation in growth, China becoming an attractive counterparty, to Trump's policies becoming, slightly more protectionist in nature rather than, friendly to globalization and global trade. Crude was making new highs, dollar was making new highs, rupee was weakening. Politically, geopolitically, also the world was going through some sort of turbulence. So I think multiple things came together in that phase of the market, and India needed a reason to get the excesses off, and I think it played out. Jan and Feb, Indian markets corrected very rapidly and sharply. March onwards, once again, we see stability in the markets. So the way I look at it is, one was the whole COVID correction, recovery, rally. Then was the consolidation post-COVID. Then was the massive rally from 23-24. Then was the consolidation due to valuation excess. And now is the new era of the trade war and the Trump era. So in this phase, I think very evidently, when Trump took power, people didn't find India very exciting because of, compared to other emerging markets, we were very richly valued. compared to US, our currency was weaker and everything became pro-America and anti-emerging markets due to dollar also. And crude also didn't, help us much in that phase of the market. But the way we are looking at things now, a lot of things have changed. And, we've done some deep research on the previous trade war as well. So we're trying to draw some parallels here between this scenario and the previous scenario. Some things that look interesting for India now is we are in the top 4 economies in the world. We're in the top 4 markets in the world, give or take a couple of points of vulnerability in our market cap. So we are in the largest markets, the largest economies, the fastest growing economy in the world. All of that is already taken in by the markets. The world knows it, foreigners know it, domestics know it. So from a size perspective, India has never been a market that you can ignore in the last 4-5 years. Other than that, what played out really well for India is dollar has weakened significantly, roughly 14-15% from its recent highs. Crude has weakened roughly 15-20% from its recent highs. Both of them are extremely positive cues for India. India has also seen 3 to 4 rounds of RBI's liquidity infusion. We've seen 2 rounds of rate cuts, 25 basis points each. For the last 3 to 4 months, our inflation print is consecutively moderating. So we're seeing very strong improvement on the inflation front. For the last quarter, once again, we're seeing PMI numbers stacking up very well. We're also seeing that government capex is back on track. And automobile numbers are also pretty encouraging, given which point of the cycle we are in. We're not at the start of a cycle, we're in the middle of a cycle. And we're coming out of a mid-cycle dip, so to say. So from a domestic, macro perspective, whether I think of macros in terms of liquidity, whether I think of macros in terms of growth, whether I think of macros in terms of policy, I think India is very, very well positioned. Even from a trade war perspective, I think we are a friendly neighbor amongst all hostile neighbors to US. And India is likely to be the first country to actually strike a bilateral trade agreement, which is going to be mutually beneficial for both countries. So in the post-trade war world as well, post 2nd April, India has been the best performing market in the world. The other thing to note here is that till April, India was a very weak market. So for the last 12 months, so looking at financial year 25, India was actually the only global market that did very badly. All other global markets performed very well due to various reasons, some domestic, some globally, contagion reasons, but global equity markets did very well. Indian markets were decoupled in their underperformance. And the decoupling was because of mainly domestic focused reasons like valuation excesses, growth moderation, crude, dollar, anti-emerging market stance, China being a cheap market and getting, renewed growth triggers. So foreign capital moving there. A lot of excesses and flows in India were reversing with excessive FIIs selling. So I think all the domestic focused reasons led to an India correction. And when India was correcting, all the global markets were rallying. And now I think the tables have turned yet again, where India is a relatively stronger market compared to the world, and global markets are much weaker because they are more vulnerable. And I think the big reason for this is if the global economy does go through some moderation in growth, crude, metals, some of these prices can look weaker for some time. And if input costs are weaker due to lower demand globally, India will stand to benefit, at least from an inflationary and an input cost pressure perspective. The other thing to note here is India is a mainly domestic focused economy, where majority of our production, consumption, manufacturing is for the country itself. From a services standpoint, yes, we do rely on global markets and global players, but there are very big sectors in India that are mainly domestic focused. So I think it's important to understand that from a global trade perspective, many pockets of India are resilient and are pretty much unaffected by trade war. So our portfolio is positioned to a great extent to own sectors and stocks which are resilient and focused on the domestic economy. Of course, over and above that, we have plays which are reliant on the global economy, but that's a smaller aspect. So, just to give you a perspective, plays like agrochem, chemicals, pharmaceuticals, IT, metals, these are globally exposed plays. Some of them can have a tail reward. The tail risk is already played, but the tail reward can still play out if things were to change over the next 60 days as policy clarity emerges. So I think bulk of our portfolio is focused on domestic centered companies and businesses. And we do have some names which are still focused on the global export play. And even within the export packet, we've tried to choose businesses that are relatively better positioned compared to other global countries ka similar business. I think even when we look at tariffs, we need to look at the relative differential. If the whole world is becoming expensive because of tariffs, India just needs to be cheaper than its peers. It doesn't need to have zero tariffs. It just needs to have lower tariffs than the other players. So I think from that standpoint, India is very resilient and should be lesser impacted from a tariff play as well. Having said all of this, I think the valuation excesses in large caps, small caps, and mid caps, I think bulk of the froth is out. Small and mid caps were trading at 35 to 40% premium to long-term averages. I think the premium is now in the 12 to 18% range. Large caps were trading always at a discount, but I think the discount has improved over the last 6 months. At some point, we were trading at 8% discount. As the markets corrected more in Jan, Feb, our discount increased meaningfully to roughly 20-22%. Now we are back to the 12-13% discount to long-term averages. So I think from a valuation standpoint, while it might not be lucrative or mouth-watering or a no-brainer trade, it's definitely not valuations are not a concern anymore. It's not something that can drag markets down to a big level because of valuations alone. So overall, if I look at the major drivers of the market from here, valuation, which was anti-India, is now not anti-India. I would still not call it pro-India. Liquidity from foreigners, which was anti-India, is now turning pro-India, of course, because of the relative strength that Indian markets have from an economic standpoint versus other global markets. Dollar index weakening, which automatically places emerging markets in a stronger position. Crude weakening, which places a crude dependent country like India in a stronger position, and China getting out of the capital and growth race for some time till policy clarity emerges. So with some of these triggers playing out, I think India is fairly well positioned to navigate the next 12 months of uncertainty, turbulence, and volatility. Within this, our broader view is that India should be, or India rather can be, the best performing equity market in the world in this period that we are standing in, which means that in the next 12 months, if US does 4% positive, and if India does 8% positive, we are very well positioned. Or if China does 7% negative and India is, say, flat, 0%, we're still good. So I think compared to the broader basket of global equity markets, India is positioned to outperform with multiple triggers in place. Of course, some new risks have emerged over the last couple of weeks. India was the only country which was extremely shielded from a geopolitical stress perspective. And I think that factor has started going against us over the recent past with the happenings in Pahalgam. So some stress is likely to emerge from that event, and that could keep markets a little choppy or in a consolidative stage for some time. Other than that, I think the sharp recovery of roughly 7-8% that we've seen from recent lows played out very, very fast, which means that markets can take a breather from here on for some time till things stabilize, till the news is digested and things normalize from a policy clarity perspective. So overall, we believe that Indian markets are well placed. The Indian economy is probably the best placed economy in the world right now. Valuations are not a concern, and Indian equity investors who have seen a lot of pain over the last 6-8 months should have a good cycle in the next 6 to 12 months. That is the broad view that we are making of the markets, of the macros. Now, coming to a couple of more portfolio specific things. From a size perspective, I think our portfolio will be a little more large cap biased in the 50 to 60% range, would be focused on larger caps or larger mid caps, and roughly 30-40% would be still positioned in small and mid. Within that, we will try to be positioned in the liquid universe of the market. We think in this cycle, we're observing a lot of idiosyncratic risks playing out. Idiosyncratic means, company specific, industry specific, promoter specific. A lot of these events have played out in the last 3 months. And I think our idiosyncratic risk indicator also tells us that markets have dramatically changed from the previous cycle, where a bad news would also not affect a company too much. Right now, even with decent results, good news, good outlook, even if there's slight miss on expectation or commentary, stocks are being punished very, very sharply. So I think overall, there is some selling pressure in India that is still playing out in this part of the cycle. So it's not going to be an easy bull run like the one we've come out of. It is going to be choppy. It is going to be challenging. So our size positioning is going to focus on slightly more larger cap orientation in this cycle. From a sector perspective, as I told you, I think majority of the portfolio will be positioned in domestic focused place, but we will still have 20 to 30% of our portfolio positioned in global place, because that can be a high beta or a higher risk reward play within the portfolio. It's important to understand that the last 30 days and probably the next 20-30 days will see a slightly higher ratio of churn and rebalance in the portfolio. As you all might have noticed, from October till pretty much March, our portfolio was quite stagnant. After this event, the portfolio has been changing. Some new bets have played out very well. Some old bets which we've been trimming, the exits have been good. Some things which are still lying in the portfolio might have hurt the portfolio a bit. But overall, we are realigning the portfolio to the new world order, to the new trade policy order. Again, there is lower certainty. So uncertainty is going to be the norm for the next couple of months. And once we've recalibrated the portfolio over the next couple of weeks, I think then we could see a period of significantly lower churn in the portfolio. Right now, sector persistence and factor persistence is at all-time low in India. What I mean by this, sectors don't actually persist or move despite positive triggers on the upside or negative triggers on the downside. And there are multiple examples. Pharmaceuticals, staples, IT, metals, defense. I think all the news is getting discounted extremely fast, and then the persistence is reducing. So there are no plays right now in the market which are free or void of volatility. So we need to be prepared that this phase of the market, even if you're in the right pockets, you will still see an extremely choppy move in stocks and sectors. Even from a style perspective, we are seeing very low persistence compared to the last roughly 30 months in India. So June 23 to June 24, we saw a very clear value and momentum style play out in India. July onwards, we started seeing a very clear low volatility and quality play in India till December. After December, we've seen patches of quality, low volatility, a bit of value, a bit of growth, but none of the factors are persisting in the last 4 months. And in the bear market downturn in India in the months of Jan and Feb, surprisingly, factors which were traditionally defensive, such as quality, they have also taken the beating. Sectors which were traditionally considered defensive, such as pharma, IT, staples, they have also taken the beating. So I think the last couple of months have played out very differently. None of the factors are able to hold ground. None of the sectors are able to persist to move. The news flow is changing fast. The trade dynamics are changing fast. And I think the uncertainty of how things will play out is very high at the moment. Having said this, our portfolio approach will be to slightly increase the portfolio beta, to focus a bit more on value in this phase of the market, to have some exposure to low volatility, and focus within the quality universe. So quality, value, low volatility, and beta, these are some of the factors that our portfolio is going to try to focus on in this phase of the market cycle. Beta will come because as the markets are likely to recover, higher beta plays will, reward investors. Value, because a lot of sectors have seen significant correction, and with rate cuts as well, I think value should be a critical factor to consider in this market. Beaten down stocks, beaten down sectors where valuation excesses are not already baked in. I think the risk reward should be better in the value factor. And more importantly, over the last 12, 13 months, or rather 8, 10 months, value as a factor has underperformed quality with a very big margin. And therefore, usually factor cycles tend to reverse. So our portfolio should be focused on value, beta, low volatility, and quality, because still the worst is not behind us. We should still expect some choppiness in the next few months as well. Having said all of this, I think I've given some insights on what your portfolio is likely to be positioned in terms of sectors, in terms of size, in terms of style and factor orientation. Happy to take a couple of questions and address whatever doubts investors, distributors, partners might have. Nupur, you want to take some questions?
Probably, obviously, Siddharth, we have touched upon majority of the point where people wanted to understand how the portfolio is going to look like in coming quarters, which I believe you have answered. Yeah, one thing we can touch upon will be on a currency side, because we have a lot of NRI investors on the call. They will also be interested in knowing, because for them what it matters is the dollar returns at end of the year. So we have seen probably rupees trending in past few days. But having said that, obviously, when we look at the longer term, could be the advantages on India in terms of the currency? That can be an interesting thing for people to understand.
So I think over the last 12 months, we've seen a cycle where the dollar has strengthened and the rupee has weakened. In this cycle, if I look at the last 1 year change, from trough to peak of how rupee weakened, it was slightly higher than its longer term average. So you should expect some sort of mean reversion or normalization in currency returns as well. Having said that, when we are investing in an India focused portfolio, our focus should still be to make equity returns rather than just currency returns. Because if currency has favored NRI investors in a certain cycle, it could also be unfavorable in a certain upcoming cycle. And given the current macro setup, looks like rupee should be as strong as it is or slightly stronger as we go ahead, because of the relative macro positioning of India versus the rest of the world markets. India is far from a recessionary state. India is far from a rate hike cycle. India is far from a inflationary market. And I think US is unfortunately facing inflationary pressures due to the new set of policies. It is facing a not rate hike, but I think the rate cuts are not so likely in an inflationary market. So yields should be tight, yields should be high. And even from an economic standpoint, it's quite evident that the US economy is on its way to slow down. Having said all of this, it's important to understand that when you look at investing opportunities in US and India, from a fundamental strength perspective and a macro strength perspective, India is extremely resilient, even in the trade war scenario. And I think because of the trade war scenario, India has become even more resilient. So we need to understand that the macro growth, the economic growth, the fundamental growth of India should be able to help, mitigate to a certain extent some currency deviations. We're also noticing a couple of important, indicators, quantitative indicators in the market. Let me just flash my screen on that one. I think my screen is visible. So I think we look at market breadth as a very key indicator to identify major inflection points in cycles. And I think our breadth indicators are giving us a very clear picture that when the markets, consolidated or corrected meaningfully in the previous cycles, the breadth was at current levels of roughly 45%. We are also saying that when the breadth collapses to this level, history suggests that the risk reward for equity investors becomes very good. And currently at 40-45%, 12-month breadth, we feel that markets give you a very good entry opportunity from a medium to long-term perspective. Even from a style orientation perspective, we are seeing that the style factor spreads between momentum and low volatility, small caps and large caps have come off meaningfully. So even from a style perspective, we believe that, Indian markets are very, very well positioned. And even if I look at, the last couple of years, just give me a second. Sorry, I'm not able to find the chart I want to talk about. Yeah, this is the one. So, looking at how India has done in the current trade war, it's very important to see that India was the weakest market in the last 12 months in the world till 31st March. And in the recovery, India has actually been the best market. So in the post-tariff world, India is extremely well positioned. And this was the narrow point that I was trying to make. And in terms of, factor spreads, again, we are looking at cyclical troughs. These are the points of the market cycle which are rare, don't happen too frequently, but give investors a very good entry point. What this simply means is that momentum as a factor has underperformed tremendously versus low volatility. Momentum is a higher risk factor. Value as a factor has underperformed tremendously versus quality in the last 12 months. Value is, of course, a higher risk style of investing. Quality is a safer, more stable style of investing. Similarly, small caps and large cap spreads have also contracted. Again, this tells us that markets were in a complete risk-off mode. They were de-risking, deallocating to higher risk, and trying to be as defensive as they can. And now the spreads are at or near zero, which means from here on, markets could actually reverse and make a meaningful comeback. But the meaningful comeback should also not be equated to the COVID world and rather to a more long-term sort of realistic expectation of market returns. Let me just give you guys a glimpse of how COVID really changed investor expectations. So I think this chart tells you very clearly that let's just take Nifty for example. The long-term returns of Nifty have been in the 9 to 10% range on a 5-year rolling basis. In the post-COVID world, these numbers got stretched to 16 to 23%, which means investor expectations got rebased meaningfully. Even if you look at 1-year average rolling returns of Nifty, it's 12 to 14%. This was pre-COVID and since 2006 till now. So if I take extremely long-term periods, this is the range of Nifty returns on an average basis. In the post-COVID world, these numbers got stretched to 21, 22%. Again, unrealistic expectations were baked in by the market. So, from a perspective of prudence, I do believe that investors must moderate some sort of return expectations. Markets are likely to return, I think, in the middle of these two ranges, not as high as the post-COVID world, not probably as low as the long-term averages, because we're already coming out of a correction. So from a bottom, the returns could look optically higher for some time, but the next 2-3 years, having a 12 to 15% sort of CAGR on the broader markets is something that's looking more likely, given that we've already discounted and bought a lot of future returns in the last 4 years in India. And I think the picture with small caps is also, giving you a very similar story, that historically returns have been in the 15 to 20% on a 1-year average basis for a long cycle. But in the last 5 years, post-COVID, these numbers have stretched in the 40-45% range. Again, 40-45% returns on a sustainable basis is unrealistic to expect. So I think in moderating investor expectations is very critical. Having a constructive view on India, given the way we are set up right now, is very critical. And understanding that India is the better positioned global market is very critical. And finally, understanding that the risk off is over. The risk off phase in terms of size is played out. The risk off phase in terms of factor spreads is baked in. The breadth is at a multi-cycle low. And the risk reward from this point onwards is looking very attractive. The valuation froth is also out. Valuations are not lucrative, but at the same time, they are quite, I would say, economical or practical for investors to enter.
That is very important to touch base upon how our multi-asset models have played out in terms of the core, because the asset allocation is very important for every investors to understand when they do their investing. And obviously the kind of rally that we have seen in probably precious metals in past few years, probably as a closing remark, I think that that's one of the point which we would have missed. Let's take that as
Sure. So I think our multi-asset portfolio has shown its mettle in this last 12-month cycle, where Indian markets have seen extreme choppiness, volatility, and drawdowns. I think our portfolio has outperformed the benchmark and outperformed all equity-oriented strategies with a huge margin. And I think the reason for that has been, around somewhere in August, we've made our equity allocation from 80-82% to roughly 60-63%. So we've de-risked on the equity side. Gold has been 25 to 30% of the portfolio. Debt has been closer to 10% in the portfolio. So I think the whole asset allocation piece, the risk of play in equities, the timing and size of gold allocations overall has played out beautifully well for investors. In months like January, where Indian markets saw a very sharp meltdown, and February, I think a multi-asset strategy stood out with near zero returns in 1 month when markets were down 8%, and positive returns in 1 month because of the gold rally in January. So overall, over a 2-year basis, despite all the challenges and the low volatility of the strategy itself, multi-asset portfolios have returned close to 16-17%, which for a strategy with a very low beta, with a very low risk, I think that's a very, very healthy return for investors. And even in the current cycle, having asset allocation at a family level, at a portfolio level, very critical to navigate uncertainties in the market. Gold obviously has multiple sort of triggers, playing for it. Weakening dollar is a no-brainer for gold. It does very well when, dollar's weakening and gold does well. Economic uncertainty, inflationary regimes, geopolitical uncertainty, central bank buying, a phase of de-dollarization in the world. I think a lot of factors are playing well for gold, and gold has been an asset to own over the last couple of years. And till triggers change meaningfully, just because it has run up so much, it doesn't make sense to exit it. We will stay disciplined and stay focused to dynamic asset allocation. We never owned gold in the multi-asset portfolio to make the return we did. We always owned gold in the portfolio to reduce the risk of the portfolio. And sometimes the biggest risk is the risk that you don't know. And when that risk plays out, you can't really rebalance your portfolio. And therefore, our disciplined approach to allocating to gold, to owning gold, and to have a meaningful allocation to gold played out really well for our multi-asset strategy. Any other questions that investors have that we want to take up, Nakul?
So most of them which was typed in Q&A, barring 2 or 3, maybe there are some stock specific questions, but I think that's irrelevant because the people have stock specific questions on probably bankings and all. See, India typically, if you see from the fundamental side, right, a lot of you guys have questions on the sector, which sector we should look at, which stock you should look at. Probably as a house, we believe that India is going to be very strong on aviation, hotels industry, because India is promoting a lot of tourism. We have seen the footfalls during Kumbh, we have seen footfalls probably in Ayodhya. So these are certain sectors which will have a very good tailwind in years to come in India. India is emerging as probably religious tourism destination globally. People are considering India for the travels. So probably the aviation or an airlines is a sector that one can look at.
But this might not necessarily be the portfolio or aqua strategies allocation. This is more
Obviously,
of a general house view of
general.
a longer term perspective. I think from aqua portfolio's perspective, we are positioned and likely to, be positioned in financials as a big overweight, in materials as a big overweight, in consumer discretionary as an overweight. So materials would include everything from fertilizers, chemicals, agrochemicals, cement, metals. The whole materials pack we believe is well positioned. Financials in terms of high quality, large, privately managed lenders, NBFCs is a segment that our portfolio is focused and is going to continue to focus on. We could be increasing some allocation to industrials and defense companies as well in the near term. And other than that, we would be focused on the discretionary side of consumption rather than the staples side of consumption. So I think these should be some of the meaningful areas where Aqua is constructive at the moment. Of course, as you all know, views can change, market conditions can change, portfolios can change, policies can change. Our portfolio will try to realign if there's any major shift in sector views. And another important thing, I just thought about it, that the correction that played out in India was actually a domestic focused correction and not a global contagion. And our data suggests that every time India has participated in a global contagion, the extent of correction has been more than 20. So 20 to 50, 60% has been the range of corrections led by global contagions. And 12 to 20, or rather 5 to 20, is the range for corrections due to domestic issues. So the correction that we are currently coming out of was a domestic one, and therefore a cash position or like moving out of equity was not really mandated. A global contagion is something that is playing out in the world right now, but India seems to be fairly decoupled from it, or at least relatively stronger compared to the other markets. So it's very important to understand which correction played out, why did it play out the way it did, How did the market stage such a swift recovery? And now I think from our peak, we're down roughly 8-10%, which is nothing meaningful, so to say. So it's important to, keep some of these perspectives in mind, how markets really played out and why we think India is fairly shielded in the upcoming 12 months as well.
I think so, Siddharth. I have also answered a lot of questions which was in Q&A. With this, we'll wait for 2-3 minutes in case if anyone has a specific question, please do type in either in a Q&A or a chat. We'll answer that or we'll take that, or else we can always close this call because it's been 40 minutes since you guys have been logged in. First of all, thank you everyone for participating. Do reach out to Siddharth and me in case if you have any specific questions on your investing portfolio. Trust us, it's a very good time to top up because whenever you top up in a falling market, you are getting the same franchises with a better outlook. India is going to be one of the best economy globally in terms of the growth. So when you participate in world's best economy when they are growing, you are likely to make a better returns in next 3 to 5 years. Equity has always been a long-term product. Yes, post-COVID, everybody believed that equity is the best asset class. You put money on Monday and probably by Tuesday you get 40%. Doesn't happen traditionally. So we need to understand this 3 to 5 year product. We need to stay put in it. And at the same time, please do consider topping up your investments because you are getting the same franchise, same business where there has been growth at a better valuation than their previous valuation. Um, with this, probably we would like to close today's session. Once again, thank you everyone for your participation, and we are always open for one-on-one call or any specific question that you guys may have. Can reach out to me. A lot of you guys have my number, our email ID, and you can reach out to our service desk as well. Thank you.
Thank you. Thank you so much, guys.